Gold just flipped from trade to constraint, and the next 48 hours will tell you whether this becomes a controlled retest, or the kind of forced buying sequence that leaves late sellers staring at gaps they can't fill. The comforting story is that this is just another safe haven pop after a Fed moment, and everyone can go back to sleep once the headline fades. But that story misses the mechanism that actually moves gold when it starts acting like a scarce asset again. Because this move isn't emotion, it's math. And if one key piece of that math stays tight into the next couple of sessions, you're going to see price discovery get pulled forward faster than most people are positioned for. Stick with me, because I'm going to give you the hidden detail the mainstream won't talk about, the calendar trigger that makes 48 hours real instead of clickbait, the levels that matter, what would break this thesis, and a simple next week checklist that keeps you from getting emotionally farmed by volatility. Here's the first thing you need to internalize. When gold rips this hard, this fast, especially into fresh highs, it S's rarely because millions of new buyers suddenly woke up with the same idea. Most of the time, it's because the sellers stepped back, the hedgers had to react, and the people who were leaning the wrong way got forced to pay up, all at the same time. That's where the real pressure starts. You can feel it in the tape. The candles get long, dips stop following through, and every small pullback turns into a staircase higher. But what matters isn't the candle. What matters is what the candle forces other participants to do next. And right now, the market is forcing decisions. Dealers who sold calls as premium harvesting suddenly have to hedge delta, and that hedging is not a vibe, it's an order. And when liquidity is thinner than usual, those orders move price more than people expect. But that's not the part that matters. The part that matters is the plumbing, because gold trades in two overlapping worlds. One is paper, futures, options, forwards, claims that clear quickly and can be rolled, netted, or offset. The other is physical, metal that has to be sourced, refined, moved, insured, and delivered. Physical doesn't teleport, it crawls through a supply chain. And stress shows up in the link between these two worlds, not in a dramatic default tomorrow way, in a boring mechanical, the market is paying up for immediacy way. And that right now is the hidden detail most people miss. Let me say it cleanly. The screen price can look like a normal breakout, while the real signal is hiding in the term structure and the availability of deliverable metal. The curve can start whispering tight nearby, even while the headlines keep repeating Fed, geopolitics, uncertainty. And if the nearby tightness persists into a key calendar window, it changes behavior. It changes how shorts manage risk. It changes how refiners and wholesalers quote. It changes how ETFs source. It even changes how arbitrageurs decide whether to move metal or just move paper. And if you're only watching the headline, you'll miss the shift until it's already priced. Because if this one level breaks, the math changes. So what's the calendar trigger that makes the next 48 hours a real inflection point? It's the collision of policy week optics, month-end positioning, and the way futures markets behave around roll and delivery windows. When traders say month-end, they're not talking about astrology. They're talking about flows, rebalancing, risk limits, performance pressure. The quiet procedural stuff that becomes loud when price is moving. Add a policy decision that shifts rate expectations even slightly, and you get a short-term vacuum where the dollar can weaken, real rate assumptions wobble, and gold gets repriced in a hurry. But more important, you get a moment when liquidity thins because people don't want to be the hero fading a breakout into a known event window. And when liquidity thins, forced flows matter more. That's why 48 hours isn't drama. It's the time window where the market either confirms the breakout with controlled pullbacks, or it starts gapping because the best offers evaporate. The next detail is what flips the whole setup. Here's the mechanism in plain language, without the cartoon conspiracy energy. In a normal world, gold's forward months trade with a carry logic. You pay for time, storage, financing, convenience, all that. The further out you go, the more the price tends to reflect those carrying costs. That's the basic shape. But when the nearby months get unusually strong relative to the out months, when the curve flattens hard, or in extreme cases goes into backwardation, you're seeing the market pay a premium for metal now rather than later. Not because the planet ran out of gold overnight, because the marginal unit that can satisfy immediate demand becomes more valuable than a promise. And that shows up as stress at the front of the curve. But that's not the part that matters. What matters is what that stress forces participants to do. If you're a trader short nearby futures, a tight front-end curve makes it more expensive to stay short. Your role becomes punitive. If you're a fabricator or industrial user, you start pulling procurement forward because you don't want to be the person begging for supply after everyone else already moved. If you're an ETF that needs to source physical to match creations, your sourcing cost can rise and you either absorb it, slow creations, or you induce higher bids upstream. If you're an arbitrageur, you look at the spread between regions and decide whether shipping metal makes sense. And sometimes the conclusion is simple. The economics are screaming, move metal. And other times it's, don't bother, just price it higher. Either way, the message is the same. Nearby tightness accelerates price discovery. Now, because this community is full of skeptics, and honestly, you should be, you don't take one signal and declare victory. You stack proof. So let's stack it, and I'll keep translating every technical piece into so what for the next week. Proof point 1 is the magnitude and character of the move. A multi-% jump in gold in a short window, especially into fresh highs, is not typical background noise. That kind of move usually coincides with a regime shift in expectations, rates, dollar, risk perception, or positioning reset. The so what is that after a regime shift, pullbacks are not automatically bearish. They're often retests of new value areas where the market checks, do buyers still show up when it's not exciting? And that's where you can separate trend signal from noise, but the next detail matters more. Proof point 2 is the dollar. When the dollar weakens sharply around a policy moment, gold doesn't just go up because inverse correlation. It changes global affordability and timing. A weaker dollar can pull overseas demand forward because local currency prices become relatively more favorable in some regions, and because reserve managers and institutions think in baskets, not slogans. If the dollar bounces back hard, it can cool gold quickly through de-risking. But if the dollar stays soft, or even just fails to reclaim key levels, gold's bid becomes stickier. So the so what is simple. Watch the dollar's reaction, not the headline about the Fed. If the dollar can't bounce even when everyone expects it to, gold's floor rises. And that's where the real pressure starts. Proof point 3 is rates. Not nominal rates in isolation, but the market's expectations path and the volatility around it. Gold lives and dies on uncertainty in the real rate narrative. You can hold rates steady and still create turbulence if the market is split on what comes next. That turbulence increases the value of optionality. It increases hedging demand. It increases the appetite for assets that don't have counterparty risk in the same way as credit. And it can compress the willingness of traders to stay short a runaway metal. The so what this week is that you watch not just the Fed statement, but the market's reaction in yields and the curve. If yields spike and hold, that's a headwind. If yields wobble and fail to break higher, gold keeps breathing. But that's not the part that matters. Proof point 4 is institutional flow behavior, especially when it collides with physical sourcing. When ETF demand accelerates during a gold rally, it's not just money coming in. It's a mechanical need to source metal which can tighten the short-term availability picture. On the flip side, if ETF flows stay muted while price rises, it can imply the rally is more futures-driven, more positioning, less structural bid. Both can drive price, but they behave differently on pullbacks. Futures-driven rallies can snap harder. Structural flow rallies can grind. The so what is that you don't need perfect flow data to watch the symptoms. If pullbacks are shallow and quickly bought, it often suggests there's a steady buyer beneath the tape. If pullbacks cascade and spreads widen, it suggests the move was fragile. The next detail is what flips the whole setup. Proof point 5 is inventory and deliverability categories, the stuff everyone waves around without understanding. A lot of people obsess over warehouse totals like they're a countdown clock. That's usually lazy. What matters is not how much gold exists. It's how much is available to meet delivery obligations at a given moment without paying an escalating premium to coax it out of other uses. In exchange ecosystems, there's often a distinction between metal that's deliverable against contracts and metal that's simply stored. The bridge between the two can be crossed, but not always instantly, not always cheaply, and not always in the volumes a stressed market suddenly wants. So the so what is, you don't shout default. You watch for tightening symptoms, nearby spreads, rising premiums, and the way the front month trades relative to later months. If that tightness persists into the next roll, chew, delivery window, it becomes self-reinforcing. Because if this one level breaks, the math changes. Proof point 6 is global comparison and arbitrage. Gold is global, but it doesn't trade as one unified pool at every instant. Different regions, different vault systems, different liquidity pockets. When stress builds, arbitrage pulls price like gravity. If one region bids up, metal and paper flow toward it, until the frictions overwhelm the spread. Those frictions are the hidden accelerant, refining capacity, logistics, insurance, time. The so what is that if you see persistent price strength that doesn't immediately fade, it suggests either consistent global bid or frictions preventing easy smoothing. And when frictions win, nearby tightness persists. That's where the real pressure starts. Now, let's talk about the force everyone underestimates in gold. Options, reflexivity. You don't have to be an options nerd to use this. You just need the intuition. When price runs toward commonly watched strikes, round numbers, recent highs, big psychological levels, dealers who sold options can be forced to hedge. If they're short gamma, they buy when price rises and sell when price falls. That sounds like it should dampen volatility, but in a runaway move, it can do the opposite. It amplifies. The hedging is reactive. It adds fuel on the way up. Then, when the market finally pulls back, the same mechanism can accelerate the drop. That's why gold can whip around violently, even if the thesis is correct. Trend signal and noise can look identical in real time. And volatility will try to trick you. That's the part you need to prepare for. Here's the psychology shield. Use it, because this market will try to farm your emotions. First, when gold is ripping, your brain starts anchoring to the most recent candle. You feel urgency. You feel like you're late. That's how people buy tops. Then, the market will do what it always does. It will print a sharp red candle at the exact moment your conviction is weakest. Headlines will arrive right on cue. Profit taking, dollar bounce, rate fears, geopolitical easing, pick your poison. The goal of that sequence, whether intentional or just emergent market behavior, is the same. Get weak hands to sell into support so stronger hands can reload. So you protect yourself with a rule. You don't make big decisions during emotional spikes. You decide your levels in advance. You define what would confirm your thesis and what would invalidate it. And you accept that volatility is part of the price of admission. If you can't handle the whip, you don't deserve the trend. But you can handle it if you trade your plan instead of your feelings. Because if this one level breaks, the math changes. So let's build the two scenario lens that keeps this finance credible and keeps you from marrying a narrative. Scenario one is the controlled pullback and retest. In this scenario, gold cools off after the initial surge. It pulls back toward a prior breakout zone, often a round number region or the area where price accelerated, and it holds. It might chop, it might frustrate, it might make people bored again. But the key is the character. Dips get bought quickly and sellers can't push it below a defined zone on a closing basis. The curve stays relatively supported. The dollar might bounce, but it doesn't flip the entire move. In this scenario, the market is digesting, not collapsing. The so what is, you treat the pullback as a test of underlying bid, not as proof the move was fake. Scenario two is the continuation squeeze with gap risk. In this scenario, gold doesn't give people the polite retest. It stays elevated, volatility remains high, and any small dip is instantly absorbed. That's when shorts start capitulating. That's when dealers chase hedges. That's when performance pressure kicks in and funds feel forced to add exposure because being underweight is more painful than buying high. This is where you get the fast extensions that feel unreal. And this is also where you get the most dangerous reversals because once the squeeze exhausts, air pockets appear. The so what is you don't confuse a squeeze for stability. You respect it, but you don't let it hypnotize you. You plan for gaps, and that's where the real pressure starts. Now let's talk levels, not as magic numbers, but as zones that define behavior. If gold is trading around the mid 5,000s after this jump, you can think in layers. First layer is the immediate breakout shelf, the zone just beneath current price, where the market would ideally retest and hold if this is healthy. That's your invalidation framework. And the reason you need it is simple. You can be right on the big picture and still get wrecked on the path. But that's not the part that matters. What matters is how these levels interact with the plumbing signals. If gold dips and the front-end curve stays firm, if the market still pays up for nearby exposure, that suggests underlying tightness or strong demand for immediacy. If gold dips and the curve collapses, if nearby strength fades, that suggests the move was more speculative and less structural. If gold dips and premiums in physical markets remain sticky, that's another confirmation layer. If gold dips and physical availability suddenly loosens, if you hear plenty of metal, no rush, that's a caution flag. You don't need perfect data, you need consistent symptoms. Proof stacking is how you avoid being manipulated by a single narrative. Now let's address the institutional skepticism in the room. Is this suppressed? Is this managed? Here's the honest, finance-literate answer. Markets respond to incentives. Big players manage risk. They hedge. They roll. They try to avoid being the liquidity during chaos. None of that requires a villain. It requires a structure. And the structure in gold is that paper can trade huge volume instantly, while physical adjusts slower. When demand surges, paper often moves first. Then physical catches up through spreads, premiums, and sourcing behavior. The tension between those worlds is not a conspiracy. It's a feature. And when that feature gets stressed into a calendar window, it can create violent moves that look unfair to anyone not planning ahead. That's why your job is not to rage at the tape. Your job is to understand what it forces participants to do next, because if this one level breaks, the math changes. So what comes next, specifically in the next week or two? Here's the roadmap, and I'm going to keep it concrete. First, watch for the retest behavior. If gold pulls back and holds above the breakout shelf, that's constructive. If it slices through with no bounce, that's not automatically doom. But it shifts you to caution mode because it implies the move was more fragile. Second, watch the dollar's bounce attempts. You don't need to be a currency trader. You just need to observe, does the dollar rebound actually stick, or does it fade quickly? A fading dollar bounce is supportive for gold. A sustained dollar reversal is a near-term headwind. Third, watch real rate proxies and yields for follow-through. If yields spike and continue climbing while gold tries to hold, that's stress. If yields wobble and gold stays firm, that's strength. The divergence tells you which narrative is winning. Fourth, watch options behavior around big round numbers and recent highs. If gold hovers just above a major strike zone and refuses to dip, it can be a sign of hedging pressure, keeping it buoyant. If it breaks down through that zone, the same hedging can accelerate downside. You don't predict it, you prepare for it. Fifth, watch the curve and nearby spreads. Again, you don't need to memorize tickers. You need the concept to, is nearby urgency persisting? If yes, that supports the constraint regime. If no, the market is relaxing. Sixth, watch for the telltale sign of continuation squeezes, shallow pullbacks that get bought instantly, with price making new highs even on bad news. When markets rise on bad news, it's often because positioning matters more than logic. That's the signal that sellers are trapped or sidelined, and that's where the real pressure starts. Now let's talk targets, because people want targets. But we're doing this responsibly. Targets are not promises. Targets are maps. Zones where behavior often changes. If gold is in the mid-5,000s and the move is momentum-driven, the first upside target is typically the next psychological round number in the next extension zone above recent highs. The outcome tells you which scenario you're in. The next detail is what flips the whole setup. Now, because this audience is macro-minded and institution skeptical, let's talk about the real-world supply chain reality that sits underneath all of this. Gold supply doesn't respond quickly to price. Mining lead times are long. Refining capacity is not infinite. Recycling responds, but not instantly. And a lot of gold is not for sale at any reasonable price because it's held as reserves, jewelry, or strategic stock. So when demand surges at the margin, you don't get an immediate wall of new supply, you get price. That's why gold can overshoot. It's not that there isn't gold in the world. It's that the marginal available unit is scarce in the time frame the market suddenly wants it. Time frame is everything. And that's exactly why the curve and deliverability signals matter more than the headline. So what would make me skeptical fast? I'll give you clear invalidation cues. If the dollar snaps back hard and holds while gold can't reclaim key zones, that's a warning. If yields rip higher and gold starts failing on rallies, that's a warning. If the front-end urgency in the curve collapses and spreads calm down, that's a warning. If gold breaks down through the prior breakout shelf and then fails to reclaim it on a bounce, especially if the bounce is weak and sold, that's a warning. And if you see a sequence of lower highs and lower lows while volatility stays high, that's often a sign the move was a blow-off and now it's unwinding. Notice what I didn't say. I didn't say if a pundit says so. Price action plus plumbing plus macro is the trifecta. Proof stacking keeps you honest. Stacking. Now, one more psychological trap before we close. A lot of people will get emotionally manipulated by, I missed it, thinking. They'll either chase at the top out of regret or they'll short out of bitterness. Both are ego trades. The market loves ego trades. You beat it by staying mechanical. You define your scenario. You define your levels. You accept that you don't need to catch every dollar. You need to catch the right regime. And regimes are defined by behavior, not by your feelings. So here's your clean, near-term checklist for the next 5 out of 10 trading days, and it's designed for fragile attention and real money. 1. Watch the first pullback. Does it hold above the breakout shelf? 2. Watch the dollar. Does it bounce and stick or bounce and fail? 3. Watch yields and real rate expectations. Do they surge with follow-through or stall? 4. Watch the curve, show your spreads. Does nearby urgency persist? 5. Watch the character of dips. Do they get bought fast or do they bleed? 6. Watch big round numbers. Does price behave like it's magnetized and supported or rejected and heavy? That's it. No mysticism. Just mechanisms. And if you're wondering what the hidden detail really means in practice, it's this. When the market starts paying up for immediacy, when the front end is firm and the system is incentivizing metal now rather than later, you get a reflexive loop. Tightness makes hedgers defensive. Defensiveness reduces selling. Reduced selling increases price. Higher price increases attention and flow. Flow increases sourcing stress. And stress shows up in the curve and spreads. That loop can run longer than skeptics think, and it can end faster than optimists think, which is why the two-scenario lens matters. If you're here for clean logic instead of hopium, you're already ahead of most of the crowd. Stay close this week, not because you need a guru, but because this is exactly the kind of window where markets try to shake out disciplined people with emotional traps. Keep your map. Respect volatility. Let the market show you which scenario you're in. And if you want to be part of a community that watches the plumbing, not the propaganda, you know what to do. Stick around and keep your eyes on the signals that actually move price.